Ladies and gentlemen, boys and girls, welcome to the show. I am your host with the most, Chase Money. Yes, my last name is Money. And what a day, what a week, what a year it has been. We're going to talk about it. We're going to talk about some of the market movers, some of the winners, some of the losers today, and where analysts think the S&P 500 is going to go by the end of 2025. We're going to talk about Donald Trump and everything that's been happening. We're going to talk a little bit about Bitcoin as well, but mostly we're going to look at Google's earnings, what they did, what's happening in the after hours, and where will Google go next? And most importantly, is Google a buy right now? But before we dive in, guys, if you could please go ahead and subscribe, that would really help me out. Let's dive in with a quick market overview. So we had another green day, the third green day in a row for the S&P 500 for US stocks, except for food and beverage services, which is essentially consumer staples, right? They were the only red sector here today. Everything else was actually very green, a risk on day, liquidity flowing into the markets, bonds caught a bid, Bitcoin caught a bid. Everything was green today, and you could see it right here. Everything except staples. Coke was down. Everything was red, from value to high growth. The mega caps, banks as a whole, cyclicals, sensitives. It was really only defensives that weren't in the green. And guys, this is coming on the back of when the majority of analysts, Wall Street analysts, we're looking at BMO, Citi, Barclays, Evercore, they've all decreased their price targets for the year, anywhere from the mid to high 7,000s to some as low as the low 5,000s. There's only three firms, UBS, Morgan Stanley, as well as Wells Fargo, that have not adjusted their price targets. Everyone else has capitulated. We'll see if that happens. But this is really going to show that many analysts believe that we are in for a weaker economic environment, and that'll mean weaker S&P 500 returns. And that all stems from Donald Trump and his tariff policies, and the polls are starting to show it. The president's handling of the economy, his net approval rating is now -9 compared to where they were with Joe Biden. At the same time, you could see that the approval rating does not flow. However, this poll is by The Economist, and I don't know if they are a left-leaning organization or right-leaning organization. We always have to ask these questions when it comes to the polls. However, when we look at the hard data, this is the S&P 500 return, depending on which Trump official is mentioned more in news articles. When it's Besant, stocks tend to rally. When it's Ludwig or Navarro, stocks tend to take a bit of a nosedive. Very interesting to see this right here. So we sort of do have a Besant put, I guess, underneath the market. But when Ludwig and Navarro get talking about tariffs and trade policy, things tend to go sideways. So we want to hear more of Besant, more trade deals coming to the table. And he knows markets better than anybody as well. And guys, the reason we're in this situation has to do with China's trade deal. Now, this is the series of events right here, but long story short, we are in a situation now where we're actually getting deals made with China, with India, with the EU. You know, all of these deals are coming to fruition. I believe an India deal is probably going to come sometime next week. China a little bit later. We don't know what's going on with EU. There's a lot of infighting happening at the moment. They've been very reluctant to firmly say what they're going to do. Nonetheless, it does look like tariffs have peaked. We're rolling them back right now. And how fast we roll them back, how fast we get a trade deal is going to be dependent on where markets go next. Now, diving into something completely different, guys. Banks are now officially free to support Bitcoin. We got a note here from the Federal Reserve, which announces the withdrawal of guidance for banks related to their crypto assets and dollar token activities and related changes to its expectations for these activities. Pretty much, they're deregulating the use of crypto so that people can freely use it, and they're just making it more accessible for banks. This is going to really support the use of cryptocurrencies in the economy. Will it make a change? I don't know. Nonetheless, it should be supportive for Bitcoin because Michael Saylor is tweeting about it. He's probably Bitcoin's #1 advocate, and he holds $42 billion worth of Bitcoin. But let's actually talk about Google. They just dropped their earnings, and here is their earnings summary. It was actually a very good earnings report. They smashed EPS expectations. We'll talk about why that is, but they absolutely beat it. $2.81 versus $2.01. Operating income beat by about $2 billion. Revenue beat by about $1 billion, hitting that $90 billion mark. Cloud revenue actually missed right here, 12.2 versus 12.3 respectively. And then Google ad revenue grew as well, modestly, but it grew as well. Now, the reason why we actually saw such a huge beat in EPS had to do with net income. Net income was boosted by unrealized gains in a private investment. Many people are speculating it is either Waymo or SpaceX. Nonetheless, that is why we saw a huge move in net income, and that's why EPS per share actually was so significant. Now, looking at the overall composition of Google's earnings, you can see here, this is the revenues, and this is Q1 2024 and the current quarter. So you could see right here that Google Search, the biggest contributor, actually grew 10% year over year in the quarter. That's actually significant. So the whole search is dead narrative, not the case at the moment. In fact, we also saw YouTube ads growing 10%. Google's network did decrease, but this is the lowest quality of the ads network right there. And then subscriptions, platforms, and devices grew 19% year over year, for total Q1 revenue of $77 billion. That is absolutely insane. At the same time, Google actually expanded its operating margin from 39.6% right here to 42.3%. And they reported operating income of $32 billion. Such an efficient company. To see all of this investment, the spending and growth, and still expand operating margins, that really goes to show the operational efficiency occurring in the business right now. And here is a breakdown of everything. So you could see that they beat on almost every single metrics. They beat on revenue year over year growth. They actually missed on YouTube revenue, surprisingly. We were looking for 8.93 according to the street's expectations. The estimate was for 8.97. They reported 8.93. They also missed here on the Google Cloud segment. The street were looking for 12.268. Reported was 12.26. To be honest, I would say that's in line. That's what, not even $8 million that they missed by $800,000. I don't know about that. I think that actually came in line, in my opinion. But yeah, every other segment here, including search revenue, actually beat expectations. Search is not dead. It's actually growing very, very handily. Quarter over quarter, it grew actually significantly, grew about 10%, as you can see right here, from 181 to 203. I believe that is in billions of dollars based on last 12-month revenue. You can see YouTube ad revenue, even though sequentially it did fall, Q1 actually grew against the same time last year, and it grew about 10%. And Waymo is on an absolute tear with growth. Absolutely huge growth right here, pretty much from about 10,000 rides to 250,000. So the adoption is insane. This almost looks like NVIDIA's data center revenue, right? Like it's just almost exponential, and expect much more of the same as they keep expanding geographies. And this is weekly rides. Waymo is doing 250,000 weekly rides. That is significant. The data Google is getting in right now, this is shaping up to be a real serious competitor in this space. Now, let's actually have a look at Google. Over the last year, Google is flat pretty much. They were up here in the after hours on these earnings, up 5%. So you could say that Google for the year is probably up about 5%, maybe 6%. But if we look at the last 5 years, Google has performed very, very well, up 150%. And you can see the valuation still looks largely attractive. A PE ratio of 17, forward PE of 17, but we'll dive a bit deeper into that right now. Looking at the financials, we already did tackle them. Google did a pretty good job. You can see trailing 12-month revenue, $359 billion, 12-month revenue growth of 13%. And if we scroll down to the efficiency ratios, you can see right here, a 58% gross margin, 33% operating margin, 30% profit margin, and 20% free cash flow margin. That is for the last 12 months, including the first quarter. Google's balance sheet is absolutely fantastic. I was looking at it, guys. They hold $95 billion of cash. Is that just not insane? And then if we go down here to total debt, $22 billion. So they have a net cash position of about $75 billion. It is just, they're so wealthy. Google is such a cash cow to do this. And on top of everything we saw, they also increased their dividend by 5%, right? The current yield is 0.5%. They increased that by 5% year over year. And they also authorized another $70 billion in share buybacks. If we actually go down right here, you can see that Google bought back 2% of their shares outstanding spending in the last 12 months and expect much more of the same. That is significant. And they've been doing that for quite a number of quarters. They've been buying back quite a number of their shares now. And then looking at ratios, especially efficiency ratios, this is a highly efficient entity, 34% return on equity, 21% return on invested capital. Google looks cheap on an earnings yield basis, but not that cheap on a free cash flow basis. And that has to do with all of the capital expenditures that they are currently undergoing with regards to AI, data center spend, Waymo spend, and everything else. If we actually just go to the cash flow statement, you can see a capital expenditures was $57 billion. Just 12 months ago, that was $31 billion. And they reaffirmed capital expenditures of $75 billion for 2025. So there's no slowdown in the CapEx expense. And that is really, really good news for NVIDIA and the AI trade. Amazon said the same thing. I expect Meta to say the same thing. If Google isn't slowing down, Meta won't be, Microsoft won't be, Apple won't be. All of these hyperscalers are going to keep spending because they have the money to do so. Google has $95 billion, printing tens of billions of dollars in free cash flow every single quarter. They may as well spend it on AI, which could be the next huge growth driver. We're looking 5, 10, 15 years down the track. But now we have to ask the question, is Google a buy right now? And this is how we look at valuation. So plug in the Google ticker right here, guys, and you can see here $359 billion in revenue. We're going to use a 20% free cash flow margin. And then in 2029, we get free cash flows of $115 billion. Now, the current EV to free cash flow is 17 times, right? So this is a very, very cheap company. If we actually just go to their financials, their ratios, and you could see on a PE ratio, they trade at 17 times, price to sales at 5 times, price to free cash flow 26 times. So they do trade a little bit more pricey on their price to free cash flow ratios, right? And you can see EV to free cash flow here at 25 times. So I actually have 17 right there. So that is not correct. It's actually 25 times. So what we're doing, right, is seeing a margin, seeing multiple contraction from 25 times to 20 times here in Google. That would give us an enterprise value of that number. Then we subtract the net debt and we get the equity value. Then we divide by shares outstanding. Now I am decreasing shares outstanding by 1% sequentially every single year. You could be a little bit more bullish. I'm being conservative. And with 10% revenue growth up until 2029, you get a stock price of $221 in 2029. The current stock price is $159. If you then add the dividend yield of 0.5 percentage point, you get a 5-year projected compounded annual growth rate of 7%. So is Google right now a buy? I would say probably not. It is a bit expensive on a free cash flow basis just because of all of the capital expenditures. But I'm sure if you plug in an EBITDA ratio right here, the stock probably looks much more attractive. I personally like to use free cash flow because that is the actual earnings available to shareholders that we can use, that we can accrue, right? At the end of the year, free cash flow is the cash in the company's bank account that they can use for whatever, for shareholder value, shareholder return, for capital expenditures, whatever. And that is what matters at the end of the day. And that is why I always use free cash flow. And so on a free cash flow basis, Google isn't attractive, but look, it certainly is attractive when you look at like its EBITDA ratios at 13 times, EV to EBIT at 15 times. This is generally very, very attractive and actually below a market multiple. The S&P 500's forward PE right now is about 19. Google is trading at 17. So look, Google is a significantly better company than the S&P 500 as a whole. And so for those of you that want to actually step in and buy Google right here, regardless of what we're seeing on a free cash flow return basis, I wouldn't blame you at all. There's a lot to love. A leader in AI. It's buying back a lot of shares. It pays a dividend, very shareholder friendly company, but also making the right investments to grow. And it does have some of these massive growth drivers like Waymo, which could be a huge part of their business. I mean, if we actually go back here, Google Cloud, right, is still growing at 28% every single year. Even though it missed revenue expectations, that is still growing significantly. So you have stuff like Waymo, you have stuff like Google Cloud, you have stuff like YouTube still growing at double digits, revenue still growing at double digits. Look at this, Google search, right, still growing at just under double digits. This is a company still firing on all cylinders, expanding its margins. If you want to buy Google here, I don't see why this wouldn't work out, especially when you look at other metrics. But on a free cash flow basis, it just doesn't look attractive for me. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.